We're still in inventory, still working with periodic weighted average. This is the last slide that we left off with on the previous section that we covered. I just want to point out to you again that the average is $8.30 per unit. As we look at the next slide, take note that a simple average of cost does not work here. There's no way that you can take the $7.90, add through $8.75, add and divide by 5 and get the result. It just doesn't work because they've done that and it's $8.25. And you might say, well, that's close. Close is not correct. So under the perpetual method, the average cost moves at each new purchase of inventory. The formula to determine the average cost is the same. It's where we take the goods available for sale in dollars, divide by the goods available for sale in units. All right, we're looking at the same situation. It's a moving average. The company just started up. It does use the perpetual method. So we want to know what is the cost of goods sold for each sale. If no other sales are made, what will ending inventory be on December 31st? And what is the cost of goods sold on December 31st? So the way we handle this one is going to be a little different than we did the periodic. All right. Under the perpetual method, cost of goods sold for each sale is recognized when the sale is made. So here the first sale is made on March 15th. We have a total of 357 units in inventory at this time. The beginning inventory of 140 plus the February 3rd purchase of 217. The total cost right now is $2,842 for those 357 units. We need to divide. Our average is $7.96. So that is our cost in our inventory at this time. When we sell 300 units, we're going to sell 300 times $7.96. So that means we're going to have $2,388 cost of goods sold for this March sale. To compute the cost of 57 unsold units in inventory, because we had a total of, 357. We sold 300, so that leaves us 57. We take it times 796, and there's $454 for the units that are available for sale. We're going to have to be careful here because it is possible with rounding that we may have some slight differences. All right, now that brings us up to the September 1st sale. And that sale includes previous inventory before the April 12th purchase, where we had the 57 units at $796 or $454. So that's where they've marked that through, updated. That's our inventory that we're carrying forward. And we will combine it then with our April 12th purchase and our July 18th purchase, making us have 367 units in inventory at a cost of $3,040. We need to update the average. The average now is $8.28. We're selling 250 units. And so the 250 units times 828 is 2,070. We have left the 367 less 250 leaves us 117 units on hand. At 828, 970 is still the cost that we have in our inventory. So that's updated. November 24th, we purchased an additional 240 units. Now we have 357 units before our December 12th sale at a cost of $3,070. And so we need to update. Our average cost is now $8.60. So when we sell the 128 units at $8.60, that yields an additional cost of goods sold of $1,101. And of the 357 units that we had before, we've sold 128. That leaves 229 on hand in our ending inventory after the December 12th sale at $8.60, or a total cost of $1,969. Takes more work when you're using perpetual because each and every purchase, sale, transaction we have to do an update. So the moving average example, they're showing on the screen now where you can see the 3 different sales and the fact that we had a moving average. It continued to increase from the 1st, March 15th, 796, September 1st, 828, December 12th, 860. And the reason is we acquired, as we purchased new inventory, the cost we were purchasing it at, it kept increasing. All right, so our total cost of goods sold that we have is $5,559. The ending inventory we had already computed on the previous slide of $1,969. And if there are no purchases or sales after the December 12th date, then ending inventory will show on the balance sheet as $1,969, and the cost of goods sold on the income statement will be $5,559. All right, we're ready for FIFO, first in, first out costing. And under FIFO, the assumption is that the first units purchased are the first units sold. Now, FIFO costing, the way we handle the costing in the accounting department, does not necessarily have to match up with the way the goods are actually sold out on the showroom floor. Now, periodic cost of goods sold is computed once at the end of the period after a physical count determines the ending inventory. The ending inventory then becomes the beginning inventory for the next period. Perpetual, the cost of goods sold is computed for each sale, starting with the units available from the earliest purchases. So we're looking at a periodic inventory method, FIFO. Here's our example. All right. Periodic method, a year-end physical count shows 229 units in stock. We're to calculate the ending inventory and cost of goods sold. By the way, this is the same data that we were using under the weighted average and moving average. We're using FIFO though now. Now, under FIFO, units sold are assumed to be from the earliest purchases. So the units remaining are assumed to be from the latest purchases. The latest purchase was on December 12th. 240 units at $875. Therefore, under FIFO, all 229 units in the ending inventory must be from this purchase. So we will be able to take 229 times $875 to come up with a valuation for our ending inventory. The goods available for sale, the same under average, same under FIFO, it will be the same under LIFO, given the same set of data. We have 907 units available for sale. Total cost available, $7,528. The 229 are coming from the last November 24th purchase at $875, making it $2,004 for the ending inventory. We can subtract the $7,528 less the $2,004, and the cost of goods sold, $5,524. The 907 units that we had available, less the 229 units that remain at year end, indicate that 678 units have been sold. So under the periodic method, cost of goods sold is based on the beginning inventory. The beginning inventory plus the February 3rd purchase plus the April 12th purchase plus the July 18th purchase plus 11 units out of the November 24th purchase to add up to the 678 units sold. And they're going to go through that and show each and every, out of that we need 11 out of that. And then we'll arrive at the 678. So calculating that, we can double check, verify that $5,524 is correct as we previously saw. The ending inventory, 2004. When you add that together, that adds up to the total cost of goods available, which was the $7,528. Now, the perpetual method, a year-end physical count shows 229 units in stock, and we're to calculate ending inventory and cost of goods sold. All right, let's begin with that. Okay, under perpetual, when we have the March 15th sale of 300, we're going to be selling the beginning inventory of 140, and then we need 160 out of the February 3rd purchase of 217. So that is going to leave us 57 units still available at $8 a unit. Okay, we come to the September 1st sale, 250 units, FIFO. We're going to sell out of those 57. We're going to sell 100, and then we need an additional 93 to have the 250 units to sell on September 1. That will leave, out of the July 18th purchase, we'll have 117 units left to carry forward and be available for the next sale on December 12th. December 12th, we sell 128, so that means we'll go back and we'll sell 117. We will also need to have 11 out of the November 24th purchase, and that will leave 229 in ending inventory at the $8.75. So 667, all of those that are grouped with the brace have been sold from beginning through February 3rd, April 12th, July 18th, and then 11 also out of the November 24th purchase. I'll go back to that for just a moment. Okay, so take note that whether the periodic or the perpetual method is used, FIFO yields the same cost of goods sold in ending inventory. So on FIFO, periodic, perpetual will give the same results. Catalog that away. Remember that. All right, let's look at LIFO, last in, first out. LIFO assumes that the last units purchased are the first units sold. So it has the reverse cost flow of FIFO. Like FIFO, LIFO costing does not consider which goods actually are sold, because we're again in the accounting department, in the office, we're doing the costing, the dollar amount, moving the units, without regard for how the product, the goods, are actually being sold on the showroom floor. If the last units purchased are the first units sold, then any units remaining in inventory are from the earliest purchases. The acronym we have FISH, first in, still here. Most companies that use LIFO use the periodic method. Same facts that we've been looking at. It's the same storyline. Let's look at the periodic method. A year-end physical count shows 229 units in stock, no surprise there, and we're to calculate the ending inventory and the cost of goods sold. Now, under LIFO, the units sold are assumed to be from the latest purchases, so we're going to start from the bottom. That means the units that are still in stock are going to be from the earliest purchases. So the 229 units in ending inventory have to be the beginning inventory plus whatever units we need from the February 3rd purchase to equal 229. So they're the 140 from beginning inventory plus however many it takes to add up to 229. The goods available for sale are still 907 for $7,528. The ending inventory, we'll take the 140 at $790. We need 89 from the February 3rd purchase at $8. So that's a total of $1,818. The cost of goods sold then is $5,710. Now, if 229 of the 907 units available for sale are on hand at the end of the period, it means that 678 units were sold. Under the periodic method, the cost of the last 678 units purchased are the cost of goods sold. So, looking at that, we're going to start from the bottom, the 240 from the November 24th purchase, the 450 from the July 18th, and that adds up to, how much do we have so far? We have 240, 210, that's 450. We still need more. We need 100, that's 550. We need 128 from the February 3rd purchase, 678. So those are the units that are considered to have been sold under LIFO. So the cost of goods sold calculation, we have the 2100 from the November 24th purchase, 1764 from July 18th, 822 from April 12th, and we have 128 at $8 or 1024 from the February 3rd. That's a total of 5,710. The ending inventory is 1818 because what was available was 7,528. So the cost of goods sold and the ending inventory have to add up to what was available of 7,528.